Tommy's worried the market could take a big bite out of his $600,000 retirement savings. Dean's afraid falling interest rates could drain his nest egg too fast. If you're asking yourself, how do I keep my money safe and still make it last? Then this episode is for you. Let's dive into that today on the Howdy Neighbor Retirement Show.
It's the Howdy Neighbor Retirement Show.
Howdy neighbor, Michael Andrews with Andrews Insurance and Advisory. Thanks for joining me today. Let's get right to our first question. This one comes from Tommy, who says, "Hey Michael, we've got about $600,000 saved for retirement, but everything is in a 401k. With the market all over the place, we're worried about losing too much. Are there strategies to protect some of that money still while keeping up with inflation?" Thanks, Tommy, for the great question. I hear this from folks getting close to retirement all the time, and for good reason. When you're still working, you've got time to ride out the ups and downs of the market, but when retirement is right around the corner, a 20 or 30% drop in your 401k can change your whole plan overnight. The good news is, you've got options, and you don't have to pick just one. Let me walk you through 3 strategies that could help you protect what you've worked so hard to build while still keeping your money working for you. Option number 1, the bucket strategy, organizing your money by time. So think of your retirement savings as different buckets of money, each designed for a different time frame. The short-term bucket is your safety net. So this would be cash or near cash investments that you'll have for the next couple years of expenses. This keeps you from having to sell stocks in a downturn just to pay the bills. So an example of this would be a high yield savings account or a money market account where you can access the cash anytime, or a short-term CD, ideally somewhere between 6 to 12 months, that earns a bit of interest but is still very, very safe. The middle bucket is for the next 3 to 10 years, so these investments are more stable but still offer some growth. An example would be a bond ladder or fixed income investment with staggered maturities. This gives you a more predictable payout and lower volatility than stocks. The long-term bucket is the next 10 plus years, so this is where you're going to keep your growth-focused investments, since you don't need that money right away. So an example would be a diversified stock portfolio or mutual funds that can capture long-term market growth, or a balanced ETF with a mix of stocks and growth-oriented assets that are designed for more long horizons. Organizing your money this way can give you peace of mind because you know your immediate spending money is protected while the rest has time to recover if there is a market drop. Option number 2, adding guarantees with an annuity. Another strategy is to carve out a portion, and I do mean a portion, not all of it, but a portion of that $600,000, and you could put it into something that can provide guaranteed income like an annuity. Here's how this can help. What it'll do is it will give you a steady income stream so you're not forced to sell investments at a loss when markets are down. Now, you can't usually buy an annuity inside of a 401k, so you'd probably need to look at a rollover into an IRA for that portion of the money. But for a lot of retirees, knowing a piece of their income is guaranteed no matter what the market does really takes the pressure off. Option number 3, diversifying beyond just stocks. So most 401ks lean heavily on stock funds because they're built for long-term growth while you're working. But as you near retirement, having all of your eggs in the stock basket isn't always the best move. This is where it might make sense to diversify further, so you could add in things like bond ladders, CDs, or other structured income investments that don't swing as wildly. If you roll over part of your 401k into an IRA, you will have even more tools available to help spread out the risk. The last thing that I want you to keep in mind is you're going to have to try to keep up with inflation. Let's not forget that playing it too safe carries its own risk. If you moved everything into cash or fixed accounts, it might feel good today, but over 20 or 30 years of retirement, inflation will eat away at your purchasing power. That's why the goal isn't to avoid risk completely. It's about finding the right balance, protecting what you need in the short term, setting up guaranteed income for your essential expenses, and keeping a portion invested for long-term growth so your money keeps up with rising cost. Tommy, this is exactly why having a retirement income plan is so important. It's not about guessing where the market's headed next year. It's about knowing where your paychecks in retirement will come from, having safety nets in place, and making sure that your money lasts as long as you do. All right, Tommy, thanks again for sending in that question. It's something that a lot of folks are wrestling with right now. So on to our next question. This one comes from Dean, who says, "Hey Michael, we're worried that when interest rates drop, our CDs and bond funds won't pay enough. What other options do retirees have to keep income coming in without taking on big risk?" Dean, this is a great question. Thanks so much for sending it in. A lot of retirees are wondering what happens when today's higher rates eventually come back down. When rates are higher, like they've been here recently, CDs and bond funds can look really attractive. They're safe, they pay a decent return, but history tells us rates don't stay high forever. When they drop suddenly, that safe income you were counting on could shrink. And bond funds can lose value when rates change because their prices move opposite of interest rates. So relying too heavily on these alone can put your retirement income on shaky ground. So let's go through a few options. Option number 1, laddering your maturities. One way to manage this is by laddering. So you're spreading CDs or bonds out over different maturities. That way, every year or so, something is maturing and can be reinvested at whatever the current rate is. It's not a perfect solution, but it helps smooth out the risk of locking everything in a low rate. Option number 2, annuities for guaranteed income. Another option is to use part of your savings to buy guaranteed income through an annuity. Essentially, you're taking a portion of your nest egg, you're turning it into a paycheck that lasts for life. Unlike CDs or bond funds that fluctuate with interest rates, an annuity can give you certainty. You know exactly what's coming in each month, no matter what the market does. The trade-off, though, is that most annuities don't automatically increase with inflation, which is why it's smart to keep other money invested for growth to help protect your long-term buying power. Option number 3, dividend-focused investments. So if you're comfortable with a little bit more risk, dividend-paying stocks or ETFs can be another income source. What happens is these companies share profits with investors, and historically, dividends can grow over time, helping you keep up with inflation. Of course, stock values go up and down, so this isn't your safe money bucket, but it can complement other strategies. The bottom line is relying solely on CDs and bond funds can leave you exposed when rates drop. By mixing in guaranteed income options and investments that can grow dividends over time, you create a more stable, reliable paycheck that is not tied so tightly to interest rates. And just like we talked about in the first question, it comes all back to having a real retirement income plan, not just a pile of accounts. That plan tells you where your money will come from next month, next year, and 20 years down the road. So that is going to wrap it up for this week's episode. I am Michael Andrews with Andrews Insurance and Advisory. Whether you're tuning in on KPRV 92.5 FM or catching the replay on Facebook, YouTube, or our podcast, I appreciate you spending a few moments with me today. If you've got a retirement, Medicare, or investing question you'd like me to answer on the show, if you would, head on over to andrewsinsurance918.com and click on Howdy Neighbor and send in your question. And if you want to take this relationship to the next level, you can always book a one-on-one call right on our website. Just head over to andrewsinsurance918.com, click on my calendar link, pick a time that works for you, and we will talk through your retirement questions in detail. Be sure to like, follow, and share this episode with friends and family who could use some straight answers about retirement. Thanks again for listening, and we will see you all next week right here on the Howdy Neighbor Retirement Show. Thanks.
It's the Howdy Neighbor Retirement Show, helping you plan so your money will grow.